Hey guys, it's Nick, and in this video I want to talk about bankruptcy stocks in general and Hertz bankruptcy stock in particular. Hertz is up to $1.70 a share, and that's crazy, and it's probably up because of this news that people are misinterpreting, that there's another bidder for the assets of Hertz in bankruptcy court. So now there's two bidders. And people see this and think, oh my God, it's a bidding war and I'm going to make all this money. And they're actually buying Hertz stock, which is going to be canceled and it's going to be worth zero. So guys, in this video, I'm going to explain really simply how the whole bankruptcy thing works and why stocks turn out to be worth zero after most bankruptcies, Hertz included. So let's have a look at the actual press release and see what they're saying and what they're not saying. So here the story is saying bankrupt Hertz is considering a rival takeover, blah, 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 from another group. It says the proposal rivals an earlier one from Knighthead Capital and Certarus Management. And so here in plain English, it says the company said key material issues that remain to be resolved include final determinations of how much Hertz would be worth after new investments by each side and how much lower ranking creditors would recover. So they're talking about lower ranking unsecured creditors. Curiously, they didn't say anything about how much common stockholders would recover, right? And here it says, under both proposals, Hertz would emerge from bankruptcy as a public company according to the documents. Now people see this and say, wait a minute, isn't Hertz already a public company? Yeah, it is, but that stock is going to be ripped up and they're going to create new stock for the debt holder who will be the new owners of the company. It says, early in Hertz bankruptcy case, the company's stock price rallied, even though company officials said it was doubtful shareholders would get anything back. And here, this distressed debt analyst at Bloomberg Intelligence said, if shareholders were ever going to do anything, they better do it quickly and come with a big check. It's all about the economics to the unsecured note holders now. What he's saying is, if shareholders want to step up and, make their own offer to buy out Hertz, they're welcome to do so, but nobody is doing that. And so what they're saying is it's only about how much the unsecured note holders are going to get in this new Hertz company. Here it says both reorganization proposals would solve Hertz's most pressing debt problems according to the court documents. Each would pay senior lenders, including first and second lien claims, in full, and then lower ranking debts, including those held by note holders and other unsecured creditors, would get cash and the right to buy new equity at a discount. So the guys who have unsecured debt are going to get to buy the new stock at a discount. Not the stock that you're holding, HTZGQ. No, that stock's going to be ripped up. The new stock they're talking about. And if it's still not in plain English for you, take a look at this. Hertz progresses towards Chapter 11, exit in second quarter, blah, blah, blah. Okay, let's see. The plan, as initially filed, would fund the payment in cash of all senior claims and 70-cent payout to the company's unsecured creditors, which means the secured creditors get all their money back. The unsecured creditors get 70 cents on the dollar, which means if the unsecured don't get paid in full, the stockholders get nothing. And so that's what they're saying right here. And here it says both proposals contemplate that the company will emerge from its Chapter 11 as a publicly traded company with up to approximately 80% of its shares owned by the holders of its U.S. unsecured funded debt obligations. Yes, nothing saying 80% of the new company will be owned by the people that own HTZGQ on the pink sheets right now. Okay, and if you still want to believe because you see the Hertz stores are still operating and the summer's getting good and states are opening up and it's going to be a good summer season, and yeah, all that could be true, but here you go. The company's existing common shares would be canceled. Okay, it doesn't get any clearer than that. So guys, I'm going to give you an example of Mr. Hertz starting with no cars and just some money all the way up to him going bankrupt. So you understand how the whole bankruptcy works with stocks and bonds and unsecured and secured debt. Now, I have done other videos on Hertz. I've done videos on JCPenney, GNC, Chesapeake Oil, all of them about going bankrupt and that their stocks are going to be canceled. And all of the other ones have so far, even though people didn't believe me or said, well, I was just at JCPenney yesterday and they're still operating, or I went to GNC, so how could the stock be zero when they're still operating? I'm going to explain it here, so check this out if you want to understand it simply. So let's say you're Mr. Hertz, you don't have any cars, but you have an idea to go into the rental car business. You have $100, whatever this represents, $10,000, $20,000, whatever. You take this money and you buy exactly one car with it. So you spend the money and now you have the car. So it's just you and a car that's owned outright, and you start renting it. So now the car starts making money and you make $5, $500, $5,000, whatever you want to call it. And you know, $1 is for expenses of the car, gas, insurance, whatever. But these $4 now go to you because you own 100% of that car. You paid for it in cash. There's no loan on it or nothing. And so as long as you keep doing this, you keep making money, right? But you think, this is such a good business. If one car makes me this kind of money, maybe I should have more cars to make even more money. But this money you have maybe is not enough to buy more cars. So what do? What you do is you go find investors or your friends or your brother-in-law or anybody who's interested in investing in this business. Now, since you own 100% of the stock, you tell them, okay, you guys each give me 100, right? So I could buy 3 more cars and I will give you some stock in the company. So let's say, you know, for each of their 100, they get 10% each of the company. So they give you 100, 100, 100, and you give them some stock, some stock, some stock. You still own 70%, they own 10% each. And now with that, you can buy more cars. Now, everything is fully owned and paid for. So the only thing you have in terms of expenses is gas, maintenance, insurance, that kind of stuff. But everything that these cars make go to you, 70% of it, and 10% to each of these guys. So everybody's happy, they're making money, and so far life is good until you want to expand some more. So your dream is to expand with multiple stores all over the country with a whole bunch of cars in each location that you can rent out to make a lot more money. But it takes a lot of money to do this. And so what you do is either you sell bonds to the bond market or get a loan from a bank. Either way, the bank is going to ask for a secured loan, or the bondholders want a secured loan, meaning that they give you this cash and you sell them this secured bond. And this bond, the security is maybe the real estate, let's say, on these offices and the land under it and all of the cars. So if you ever default on a payment to them for the interest, they have the right to demand all of the payment, and they can seize all of the stores and the cars, whatever is secured in this bond. So that deal is done, and now these stores are making money, and these are their earnings. And when the earnings come, the first payment has to go to the bank for the bonds, the secured bonds. After that, then they can pay the stockholders, right? So they get dividends or retained earnings or whatever, right? So far, so good. The bank gets their interest and the shareholders get to share in the profits of the company. So things are going well and borrowing costs are cheap. So you sell some more bonds just because you can, and it's cheap, and it will help you, weather any storms or expand, or you have all kinds of other creditors. Maybe you have a gas company that sells you gasoline, or a maintenance company that maintains all the store's grounds or something like that. You have all kinds of creditors as you go along, but those creditors are unsecured. Let's say, so along with those, you sell some bonds to the corporate bond market. People are always looking for good bonds to invest in, so you sell some, and so you get some money from the bond market here, right? And you give them bonds, unsecured bonds. So now everything's going good. You're still getting the earnings from all these stores. Maybe you're expanding, whatever, business is good. When the earnings come, first thing, you pay the interest to the bank on the secured bonds. Next thing, you pay the interest to the bond holders for the unsecured bonds and any other services or unsecured creditors that you have, you pay them. And then whatever's left over, you pay to yourself and all the other stockholders in dividends or retained earnings or whatever. But the thing is, you guys no longer really own the company outright, because you have these guys and these guys above you who have to get paid first. And if they don't get paid, then you don't have a company anymore. If this guy doesn't get paid, he takes all this stuff and sells it in a fire sale for whatever he can get. That's his right to do that. And so when business starts going bad, or the whole country is shut down and nobody's renting cars or whatever, maybe your income no longer looks like 10, 10, 10. It's more like 10, 1, and 1. So what do? Pay 10 to the bonds, the secured bonds, and you only got 2 left over for these guys. But these guys deserve 10. Their contract is for 10. So that's when you enter bankruptcy, because these guys say, hey, you're supposed to pay us 10. If you can't pay us 10, then we are going to go to court and have you sell off whatever you can to pay us what we're owed, even if it's 70 cents on the dollar, 60 cents on the dollar, 80 cents on the dollar, whatever that is. So what happens in bankruptcy court is that these guys, the secured bondholders, and these guys, the unsecured bondholders, talk amongst themselves in bankruptcy court with their lawyers or whatever, and they say, listen, this business is bad right now, and things are not going good, but we don't want to burn it to the ground and scrap everything, because then we're both going to lose. We think that maybe if we get rid of some of these cars, maybe a few locations, we could probably keep this thing going as a new company, a going concern. It's a business that makes money in normal times. We can keep it going. So let's, you and us, come to an agreement, and maybe we'll even put up some more money to get this thing, to continue it going as a going concern. Now, these guys don't want to lose everything that they're owed if they were to liquidate everything. So a better deal is, maybe instead of getting their $10, maybe they get $7. So in the bankruptcy deal, they get $7, the secured gets their $10, and maybe these guys put up some money, maybe these guys put up some money. They issue new stock. These guys get a discounted price on the stock because it doesn't cost the bank any, the secured bondholders anything. And so they work together and they say, okay, we're owed 20, but we're going to get 17 total, and put up some money, keep this business going. And these guys over here are saying, oh, that sounds awesome. What do we get? I see you guys made a deal. Everything's great. We're going to exit bankruptcy. And these guys are like, yeah, you guys are no longer involved in this company at all. Your stock is garbage now, okay? We own the company. You guys own nothing. Okay, this stock gets canceled, as it says in the news. And what happens is these guys become the new stockholders of the company. And so they could issue stock, they can make it public, they could keep it private, they can do whatever they want to do because they are the owners of the new company. When you see Hertz stores and cars still being rented and all of that, people don't understand, and they say, how could the stock be a zero when I see them exiting bankruptcy? They're still operating and all that. Yes, they are under their new owners. Kind of like if you get a mortgage from a bank for a house and you stop paying the mortgage, what happens? They don't destroy the house. No, the bank throws you out, sells it to somebody else. There's a new owner. So when you walk down the street, you say, hey, that house is still there. How can the guy who lived there be bankrupt or whatever? You know, he no longer owns it. The house still stands, but there's a new owner to it. Same thing with Hertz and other bankruptcy stocks. They may still be operating, but there are new owners, and those are the owners who put up money in loans, not in equity to buy a piece of the stock. So bonds are senior to equity all the time. The secured is senior to the unsecured is senior to the stock. If the secured and the unsecured do not get paid their interest, you no longer own your company. They have a right to liquidate it so that they get paid. That's the agreement you make when you borrow money from a bank or selling bonds. So guys, just to show you how the money flows from secured debt to unsecured debt to common stock, let me give you an actual example. I hope I don't make a mess of this. This is the common stock pot. The stockholders, they get their earnings, their dividends, whatever. But if there's debt in the company, then the unsecured debt has to get their money first before anything flows to the common stockholders. And if there's secured debt, they are the top of the pile. So before unsecured gets anything, secured has to get everything that they're due. Before common stock get anything, unsecured has to get everything that they're due. So how does that work? Like this. Okay? You have to fill up the secured debt's cup before anything flows to the unsecured debt. The unsecured debt has to get all of their cup filled up before anything flows to the common stockholders. So in bankruptcy, the unsecured debt didn't get completely filled up. So what does that mean? If they're not getting filled, these guys get nothing. And that's what's happening in Hertz, and that's what happens in most bankruptcies, Chesapeake, GNC, JCPenney, all of that. There's not enough water to fill this one up, so these guys take the company, get rid of this, and they become the new owners of the company, and they do what they want. Issue new stock, keep it private, whatever they want to do. So guys, I hope you got a clear picture now of how bankruptcy and bankruptcy stocks work and how the bondholders have to get paid completely before the shareholders get anything. And if that's not possible, shareholders get nothing. If you don't believe me, go look. If you bought Chesapeake stock when it was bankrupt, go check it now. It's trading again under the same symbol, CHK. It's $40-something. But if you have it in your brokerage account, the bankrupt one, go look. There's nothing there because that stock was ripped up and the bondholders made a new stock that they now own. You do not own it. Same thing is going to happen with Hertz. Don't be fooled just because the stock's $1.70 and people are buying it thinking something's going to happen because they still see it operating. Yes, it's going to operate, but under new owners and under new stock owners. You will own nothing. So if you still have Hertz, I recommend you dump it before this bankruptcy deal happens. It's supposed to happen, I believe, April 16th. Now, don't wake up one day and go look in your brokerage account and see your Hertz stock is gone and there's nothing there and you lost all your money. Guys, I hope you liked this video. If you did, give me a thumbs up and I'll see you on the next one. Thanks for watching.